From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
You're listening to Money Talk for May 15th, 2026. Let's have a peek at the calendar. Your Milwaukee Brewers are home all weekend battling the Los Angeles Dodgers. You can join Ex-Fabula tonight for their annual All-Stars event, where some of the city's favorite storyteller alumni return to the stage at the historic Falcon Bowl in River West. And it's the final weekend of the Brew City Birding Festival. Check out all the birding tours and other feather-friendly programs at the Urban Ecology Center. Okay, from local flyers to high-speed drivers. A traffic camera in New York recently issued a speeding ticket to a black Trans Am modeled after Kit from the hit show Knight Rider. What's the problem? Well, they ticketed a car that hasn't left its home in an Illinois car museum for years. No word on whether David Hasselhoff was the one responsible for hitting that super pursuit button. Speaking of high-stakes engineering, a woman from Manchester successfully defended her title in the second annual Flat Pack World Championship. Now, for most of us, opening an IKEA box is less a hobby and more of a legally binding test of your marriage. We spend hours decoding vague, wordless pictograms designed by Swedish sadists. But these brave contestants willingly raced against the clock for the ultimate glory, the coveted golden Allen key. Truly a hero for anyone who's ever finished building a bookcase, looked down and realized they have 4 mysterious leftover screws and a permanent 5-degree tilt. And finally, our strange headline of the week. Sicily police investigate illegal race with horse-drawn carts and Kalashnikovs. You know, if the horsepower is not going to get you across the finish line, the firepower might. On the podcast today, Steve Giles, Kendall Bauer, and with a look back at the week, here's Adam Baley.
Well, thanks, Jason. I appreciate it. It has been a wild ride this week. Started off with some gains earlier in the week, only to give it back all on Friday. For the week, the Nasdaq finished down 0.1%. S&P 500 was up 0.1%. And the Dow Jones Industrial Average finished at 49,526, down 0.2%. For the year, however, Nasdaq remains up more than 12%, S&P 500 up 8%, and Dow Jones Industrial Average up around 3%. The 10-year Treasury selling off and yields rising up to 4.6%, just capping off what has been a pretty wild ride so far this week. Stocks briefly hit new highs after the bonds sold off on the persistent inflation. And, Kendall, you and I were talking before the show that, what has really been leading this is the AI-fueled rally. It's still in play, even despite some soaring inflation and higher borrowing costs. Both the S&P 500 and NASDAQ kind of hitting some intraday record highs this week. I'm curious on your thoughts on all of this.
Yeah, it's an interesting divergence between strong tech-driven rally in markets and some concerning signals from the bond market with the potential for inflation, as we've seen this week, which we'll get into some of those numbers in a minute, starting to kind of rear its ugly head. And so I don't know how long the market can stay afloat on strong rally on the AI trade, but we'll see.
So much of the growth in AI stocks really has come on growth of earnings and earnings potential and the AI build out, whether it be data centers or sometimes even just the tractors needed to clear the field to build the data centers. There's been a lot that has been swept up in this rally. And we've seen that earnings, when we started the year, were expected maybe to be up 14, 15%. As we've kind of encompassed the second quarter earnings season, earnings could be as high as north of 20, 25%, although candidly so much of that is expected to materialize in the second half of the year. And if it doesn't materialize, we have some volatility in front of us. But, as I'm looking at it, stocks are still relatively expensive, 22 times future earnings. It all comes down to interest rates and earnings. Interest rates a little bit higher with the 10-year Treasury at 4.6, forward-looking PE of 22 times future earnings. Steve, as you've been watching the market, anything that jump out to you?
Well, I do think there's a bit of a juxtaposition, Adam, between what we're seeing on the positive side and the negative side as it relates to the markets. You certainly have the positive, strong first quarter earnings, 27.7% growth rate. Yet we probably are now expecting the Fed to raise interest rates, not an expectation that we had back in January. This idea that with inflation coming out higher than everybody was expecting, and the jobs numbers with unemployment going up to 4.3%, I think the Fed finds itself in a very interesting position where they're going to be damned if they do, damned if they don't. Right? If they raise rates to try to combat inflation, will that further slow an economy in an environment where labor is already, unemployment is already at 4.3%? If they obviously lower interest rates in an effort to try to grow the economy, all they're going to do is fuel the inflation side. I think it's going to help us if we get some resolution in the Middle East, but your guess is as good as mine as to when we're out of Iran.
Yeah, how quickly it has changed from 6 to 9 months ago, where we thought, okay, inflation hadn't yet started to percolate, the economy and GDP remained somewhat stable, and we thought, oh, the Federal Reserve might lower interest rates in 2026, and that changed when you get some soaring inflation numbers. We got 2 inflation readings this week. By the way, we had a deluge of economic news all this week that the market had to digest in real time. For what it's worth, the things that we got in terms of economic numbers this week: existing home sales, consumer price index, business optimism, producer price index, U.S. retail sales, initial jobless claims, business inventories, industrial production, and capacity utilization. But for me, the 2 biggest numbers clearly were the inflation numbers we got. Consumer price index, consumer prices soared year over year, up 3.8%. That's the headline number, which includes both food and energy. What makes this number a little bit more uncomfortable is you take out that volatile food and energy and just look at the traditional core inflation. That came in at 2.8%. That is significantly above the Fed's comfort zone. Just a reminder again that they're probably not going to be lowering interest rates. If not, they're going to be raising interest rates. That was on the consumer side. But then you had producers. Producer price index, PPI for short. Again, that soared as well in the previous month, up 1.4% month over month over the year. That was a 6% surge in inflation. And you got to remember, that is a forward-looking kind of indicator on inflation where producer prices rose last month. We're likely to see that passed on to consumers next month.
Yeah, Adam, elevated inflation generally hurts stocks as it pressures corporate margins and implies higher for longer interest rates. And with this expectation having shifted from one of lowering rates at the beginning of the year to one now of raising rates, companies have to keep that in mind as they look out at their forecasts for the rest of the year.
Yeah, and how do they retain their profitability through an inflationary environment? And I think that also hits to the question, which is probably on every investor's mind right now with rising inflation, is how do we invest through rising inflation? How do we guard against rising inflation in our portfolio? Because it's a legitimate worry to have. And you got to be able to answer the question, how do you handle that in your investment strategy? And if you're worried about inflation, the best way to guard against that in your investment account is to own profitable businesses. Bar none, that is the best way to do it. And let me explain as to why. Because, to you and me, when we go to the grocery store and pay higher prices or go to the gas station and pay more for a gallon of gas, that is inflation, right? We're paying more for those items. Now stop and think for a moment, who is on the other side of that transaction? Well, in the example, it's the grocery store, it's the gas station. But in the bigger picture, it's businesses, it's the makers of the goods and services we rely on every day. And businesses have an innate ability to retain their profitability through rising inflation. So if you're worried at all, in part, about inflation, you have to own at least some profitable businesses inside of your investment account.
I do find it somewhat ironic that consumers here in the U.S. continue to complain about prices going up across the board, yet they seem to still continue spending in the face of rising prices.
Some of that might be related to their portfolio return.
Perhaps.
That's the interesting piece is
The 401k effect.
the 401k effect. You said exactly right. This idea that when our portfolios are doing well, we continue to spend. Doesn't mean we don't complain about it. We can see that through some of the consumer spending and other surveys that we talk about. But it's interesting. And again, going back to Adam, your point about protecting or guarding against inflation, I think you hit the nail on the head owning profitable companies, but also keeping an eye on the safe part of your portfolio, keeping an eye on bond duration, for example, remembering when rates go up, bond prices go down. And with the 10-year over 4.6 today and some of the longer duration stuff climbing up over 5%, it's an important time to revisit that, talk to your advisor, make sure that the safe part of your portfolio is positioned in a way that's reflective of your risk tolerance and needs.
I'll add on to that. With lofty stock valuations and rising yields on bonds, safer assets are starting to offer a whole lot more competition to stocks. You can get somewhere around 3 to 4% yield on cash. You can get obviously close to 4.5%, 5% yield on a 10-year Treasury, and a corporate version, probably 5.5%. Safer assets are starting to offer a whole lot more competition to stocks these days. The other big news that we had this week was a change of guard, so to speak. Jerome Powell ended his term as chair of the Federal Reserve, and that came to an end this week. And he is staying on as a member of the Board of Governors. He is now being replaced by Kevin Warsh, who's taking over as chairman, and he will now become one of the 12 voting members. Steve, you and I were kind of chatting about this before we started the show. Give me your 2 cents on this.
Well, I think a lot of people are worried that because you have a new Fed chairman, that Fed policy is all of a sudden going to go in a completely different direction. Keep in mind that they still make decisions by committee. All of the Fed members that are in the board do get a decision. They do get a vote. And the direction that the Fed chairman decides to take rates will be based upon what everybody votes for. He can't just single-handedly decide on interest rate policy. I also think it is interesting that Jerome Powell is going to stick around to make sure that his voice gets heard. It's not unprecedented, but it is not something that's happened in a few decades. And I do think that once we get past the commotion of the fact that it's a new Fed chairman, the Fed hopefully will get back to just sort of being in the shadows and taking care of monetary policy the way that they always have been.
Indeed. Well, thank you for listening. Our audience continues to grow, and we'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.